Hi, greetings everybody. I hope you can hear me loud and clear. And welcome to this webinar arranged by SPJIMR's Center for Financial Studies. What we do in SPJIMR and CFS is try and get some very notable, eminent people to try and mull over topical issues of the day. And that's exactly what we're going to do today. We also try and mix this with something that SPJIMR believes in very firmly, which is courage and heart. We think intellect, capability, courage, and heart all put together can solve all the problems of the world. So today's topic is navigating through a crisis. I have to tell you that I'm kind of cagey about using this word crisis. It can sound like scaremongering. It can sound like trying to instill panic. It can sound like sensationalizing an issue. But I think most of us, if not all of us on this chat, can agree that what we are going through right now is a crisis, both of global proportions as well as for India from a humanitarian and economic perspective. So what are we going to do today? Today, we're going to try and do the following. First, we try and acknowledge and dimension the size of this crisis. What exactly is this economic crisis that we are looking at? Second, we try and debate some of the short-term steps that can be taken at this point in time to navigate through the crisis. Third, we look beyond the short term, try and see what can be done for the medium term, what can we do to convert this crisis into an opportunity going forward. And finally, when we go through a crisis, normally that also shines the light on some of the institutions that we have. So we'll take a look at some of the institutions, how they stood up through the crisis, and what changes and modifications do we need going forward. If you think that's boiling the ocean and extremely presumptuous, of course it is. I mean, this is way beyond my pay grade. But that's where I'm going to fire from the shoulders of two extremely eminent people who are completely in the know and completely capable of diagnosing any crisis. They've been in the cockpit through several crises of their own, and unlike people like me who are sitting in the passenger seat and saying the pilot doesn't know how to fly, they've been right there navigating the country and the cockpit and the plane through many a crisis. So I have with me, I have the pleasure and the privilege of welcoming Dr. Montek Singh Ahluwalia and Dr. Duvvuri Subbarao to this, what hopefully will be a very illuminating chat. Now, I would have loved to dive into the questions straight away. It's kind of almost, it's a normal thing to say that our panelists require no introduction. In fact, I've been told this as well, that I need no introduction. God knows that's not true. In this case, however, my panelists absolutely need no introduction. Nevertheless, my boss at CFS and my dean at SPJIMR will never forgive me if I don't do the honors of inviting our guests properly. So I will present to you Dr. Montek Singh Ahluwalia and Dr. Duvvuri Subbarao. Very quickly, Dr. Montek Singh Ahluwalia, Rhodes Scholar from Oxford, joined the World Bank in 1968, rose up the ranks quickly, became the youngest ever division chief at a very young age. 1979, he came to India as an advisor for the finance ministry, again rose up the ranks, became finance secretary, turn of the century, joined the IMF. And then when UPA came into power in 2004, he became the deputy chairman of the Planning Commission. He held that post throughout the UPA years from 2004 to 2014. All this is well known. People pretty much know all of this. A quick personal note. I was a student of MBA in 1991 when we had those momentous reforms which we keep referring to. And it was unmistakable during those heydays, during those really momentous times, that there was this suave, very articulate, very intelligent young man who seemed to be in the thick of things as far as the reforms process was concerned. And he spoke a refreshingly different language from what we'd been used to, at least in Indian economics. So it was a welcome change from what we were used to. And such was the nature of those changes that even today, we look back at 1991 and say, we want 1991 type of reforms all over again. This is a 1991 moment. So the man behind those reforms was Dr. Montek Singh Ahluwalia. It's a bit of a myth that IMF at the point of a gun forced us to do what we were doing. That's a complete myth. Dr. Ahluwalia had written this internal note in 1990 itself, outlining what needs to be done. And India pretty much walked into those reforms eyes open and completely aware and conscious of what we were doing. And full credit to Dr. Ahluwalia, pivotal man during a pivotal time. And if anybody wants to understand what happens backstage through a crisis, no better person than Dr. Montek Singh Ahluwalia. Thank you, Dr. Ahluwalia, for being here with us. By the way, just because you've agreed to come here doesn't mean this absolves you of that commitment to have a lunch with me subsequently. That offer still stands. I'll now quickly move on to Dr. Subbarao, Duvvuri Subbarao. Again, a brilliant mind, IIT Kanpur, topper of the IAS batch of 1972, rose up the ranks to become finance secretary, went on to become RBI governor. Normally RBI governors are blessed with at least one crisis. Dr. Subbarao had the mortification of having to go through two crises. So he was navigating the country through two different crises and saw us through both of them. All of this is again well known. Pick up Wikipedia and you can see what really he's all about. A few notes on the personal side. I've had the pleasure and privilege of working or at least interacting with Dr. Subbarao over the last 2-3 years. Real privilege. Few things which strike me. One is his authenticity, and this is genuine authenticity. He can be disarmingly honest. He can be disarmingly humble. He can ask you very, very straightforward questions in a very pleasant manner. And it's not a put on. You can see that this guy is genuine. He's really, really genuine. Second part, don't let those questions fool you. He's got an extremely sharp mind and intellect. He knows exactly what's happening. So many a time the questions are actually questions for us to think out more and to try and come out with the answers. Third bit, courage of conviction. While he's got a very soft exterior, he comes across as a very nice person. I think he's made of steel inside. He knows exactly what needs to be done. And if he's convinced and he has the courage of conviction, he'll push through on that completely. And the last bit, which I really admire about Dr. Subbarao, he's a complete learner even today. You send him a document or if a document catches his eye, he will see it from end to end, word to word. I lose patience reading a 2,000 word document. Dr. Subbarao doesn't. He goes through it word to word. If anybody can put the micro and the macro together, 40,000 feet together, it's Dr. Subbarao. So it's a pleasure to know you, sir. It's a privilege to work with you and a privilege to have you here. If any of you need to know who moved your interest rates, this is your man to reach out to. By the way, I referred to both their books, Dr. Montek Singh Ahluwalia's book on Backstage, Dr. Subbarao's book on Who Moved My Interest Rates. Both excellent books, mandatory reading for anybody who's a student of economics. And no, they did not pay me to say this. So I'm going to dive right away into the questions. Dr. Montek Singh Ahluwalia has some trouble with the audio, so he might ask me to repeat some questions at some point in time. I'm hoping that's been sorted out, sir, but anyway, we'll find out in God's good time. So the agenda is very straightforward. We're trying to look at dimensioning the problem, the crisis in front of us, short-term steps to be taken, medium-term, and then institutions. I'll start with you, Dr. Ahluwalia, first, which is how big do you think this crisis is? I know it's very uncertain times. We are still not out of the woods, but given what we've gone through, over 60 days of lockdown, the COVID situation still not settling down. Now we've clearly pivoted towards opening up the economy. How bad do you think this is going to be for us as an economy? How is our GDP going to be impacted? How is our jobs going to be impacted? Business is going to be impacted. I'd love to hear your words around this, Dr. Ahluwalia. All yours.
Thank you, Ananth. Really nice to be here in what I believe is a very large audience listening to Subba and me. Hi, Subba. Good to be on the program.
Thank you, sir. Good seeing you.
We work together through these crises, and we're now working together outside these crises. On the question of how bad it is, I do want to preface, I know your interest is in the economy, but I think we need to recognize that it is primarily a health crisis.
Sure.
And the economic crisis is because we don't have a health solution. I mean, in the absence of a vaccine and the absence of a curative means, the only way we can slow this down is really some kind of a lockdown, which is what was done in all countries, handled differently in different countries. And the economic consequences are really the consequences of the lockdown, but they are worsened by the fact that the global economy wasn't in great shape. You know, the big difference between 2008 and now is that it looked as if everything was going all right. But this crisis, the health crisis, hit us at a time when the underlying assumptions of what constitutes good economic policy globally were being questioned. So now let me switch to just the pure economics. You know,
sorry to interrupt, Dr. Ahluwalia. If you can come slightly closer to your microphone, please, that will be great.
Sorry, yeah.
That's fantastic. Thank you.
Okay. I think coming to the economics, it's quite clear to me, and I think to many analysts, that we're going to go through a very bad year. The government has not actually given any official estimate of what the GDP growth rate is going to be. But I tend to think that we are in for a negative 5%, roughly, in the current year. And this is based on the assumption, not the assumption, the knowledge. April has been very bad because of the lockdown. May has also been very bad because of the lockdown. And I don't think that June is going to show a huge improvement, although we are doing a bit of relaxation. I mean, for the simple reason that the red zones account for 50% of GDP, and there's no relaxation really in the red zones. So I share the view of many people that you will see a big drop in GDP this first quarter. You know, you might see a bit of a revival in the second quarter, but that'll be from a very low level. So on the whole, whichever way you do the maths, we're in for negative 5%. Now, a negative 5% for the year as a whole implies that in the third and the fourth quarter, you'll see some sort of a growth. But even then, I think we're at best going to sort of be below, certainly below the previous year's level. Now, one thing we must keep in mind is that in the next year, that is 2021-22, it's quite possible that the GDP will grow by 5 or 6%. But it would be a mistake to treat that as recovery. Because if you're down 5% this year and you're up 6% from that level, then what it really means is that during 21-22, you'll be at the same level as you were in 19-20. So, you know, those who are thinking of investment will basically see output has just gone back to what the old potential was. Right. And that assumes that the labor migration problems, etc., can be satisfactorily resolved. Investment, which is the big driver, isn't going to come back until capacity is more or less fully utilized. So that's one negative. The second is that global exports are going to be bad. I mean, the WTO, UNCTAD, and all these people point out that global trade is going to be down. So the drivers of growth, looking ahead, are very questionable. So on the whole, I think we will have a worse recession this year than any that we've had in the past. Not 2000. 2008 was a dream situation, worse than even 1979. And by the way, this is not just India. I mean, around the world, everybody's having a tough time. So right now, the focus is how quickly can we get back to normal? And then what do we do looking ahead? And that's basically the subject of this whole seminar. One important thing we have to keep in mind, because it's such an exceptional global crisis, everybody's thrown the rule book out of the window. Right. So any effort to say, well, you know, according to the books, when this happens, you should do this. I mean, those relationships have to be rethought. I'm not saying, by the way, that therefore no discipline is important. But I'm just saying that the usual rules, the rule of thumb approach, is not going to be very helpful in the present situation.
Absolutely. And we will pick up on this and more, Dr. Ahluwalia, as we go along. Similar question to you, Dr. Subbarao, your prognosis of how bad this crisis is. And a second question to the points that Dr. Ahluwalia so well made. If you're looking at minus 5% growth, is that a one-time shock which we can recover from? Or will this minus 5%, minus 6%, whatever it comes out to be, have a lasting impact on us going forward as well? As in, can we just forget about what's happened in the past and move on? Or does this have a more lasting, permanent impact?
Thank you, Ananth. Thank you, Ananth. First of all, I want to say that it's a wonderful opportunity to be on this panel. Dr. Ahluwalia has been my friend, mentor, boss for several years. And interacting with you, Ananth, you've been my friend, and my sounding board for several years now. Thank you very much. I want to take off from where Dr. Ahluwalia left. The IMF put out the growth number for all countries in its World Economic Outlook, which came out in mid-April. Their estimate for growth for India for 2021 fiscal year is 1.9%. That was in the middle of April. By the middle of May, in just 1 month, virtually every analyst, every economist was agreed that our growth this year is going to be negative, that our economy is going to contract. And the amount of contraction is somewhere around where Dr. Ahluwalia said -5%. Just look at this. Last year, we were growing at +5%. This year, we'll be growing at -5%. That means a steep decline of 10 percentage points of growth in just 1 year. That sort of a decline, that sort of a sharp decline can mean a very difficult and disruptive adjustment even for a rich country. In a poor country like ours, it can mean enormous pain and hardship for millions of low-income households. It can mean our firms, enterprises, businesses, especially in the informal sector, going bankrupt. It can mean our financial stability becoming vulnerable. And as Dr. Ahluwalia said, even as we entered the crisis, our economy was in a bad shape. Just go back to January. What were we worried about? We were worried about our growth. Our growth, which is 8% 4 years ago, 7% 3 years ago, 6% 2 years ago, 5% last year, is going to be -5% this year. In all this, it's a very grim situation, but I do see 2 silver linings which I want to point out. The first silver lining is the relative stability of our external sector. Yes, exports have declined. The world is in a recession. There is no export demand. Everyone's exports, including India's exports, are going to hit. But so have imports. Oil prices crashed. So exports and imports are balanced out somewhat. Yes, the rupee has depreciated because capital fled the country in the month of March, something like $80 billion because of the safe haven effect. But the depreciation of the rupee in relative terms has been less than that of our peer countries like Mexico, Brazil, Indonesia, South Africa. And besides, the Reserve Bank has about $485 billion of foreign exchange reserves to buffer any volatility in the exchange rate. So I would say the relative stability of our external sector is one silver lining. The second silver lining I want to point out to is the agriculture sector. We're having a bumper crop this year. Just imagine how difficult, an already difficult situation would have been if our crops had failed. Yes, agriculture accounts for only about 15% of GDP, but it houses 55% of our population. Our well-being as an economy is actually dependent on how well agriculture does. So we're fortunate that we're having a good agriculture crop and that agriculture performance is another silver lining. Now, to answer your question about how quickly do we come back? Is it a one-shot affair? I tend to agree with Dr. Ahluwalia that next year we might come back to 5%. So 5% in 1990-20, -5% in 2021, +5% in 21-22, which means just leveling off. But I do believe that getting up to 5% next year is quite probable. The reason I say that is because this is not a natural disaster. Our factories are still standing. Our infrastructure is all there. Our transport systems are there. So once the lockdown is lifted and the economy is given a green signal to restart, I'm sure that we can ramp up pretty soon and reach at least 5% pretty soon. I'll stop there.
Thank you very much, Dr. Subbarao. That was very useful. Before I go on to the short-term steps, quick couple of questions to you, Dr. Ahluwalia, and then I'll flip the same to Dr. Subbarao as well. First is, there's been a lot of disruption in the workforce as well. Unemployment has, as measured by CMI, has gone up to very, very high levels. We're talking about 130 million people, etc. Plus, we know of migrant laborers going back to their respective villages, etc. Do you see this recovery coming through quickly of workers coming back, jobs being reinstated, and therefore demand starting again? Related to that, this is probably out of syllabus, completely different situation from what we're used to. In fact, RBI is not even able to give us a GDP or an inflation forecast. You've been a policymaker before, you've sat in the cockpit before. How do you even go about designing short-term or medium-term strategies when you have so much of uncertainty around you?
It's a tough, very tough question, actually. But, I think when you have uncertainty, you should give a range of outcomes. I believe that we should come out, we need to know what the government is thinking about. I mean, the present situation is the government has not changed its GDP forecast. The governor of the Reserve Bank, to his credit, has said that GDP will shrink, but he hasn't given a number. It's already a departure from the IMF's rather brave and, in my view, totally unjustified assessment of 1.9% a couple of months ago. But those assessments are heavily dependent on data channeled in from official channels. I think we should have a statement that, look, it's going to be negative. They may or may not say 5%, but we should recalibrate so that we know what the consequences of that negative are. The most important consequence of the negative is that revenues, tax revenues, are going to be much lower. And in all probability, disinvestment is not going to be feasible. So, there's a lot of confusion in what constitutes a stimulus. I mean, if you think that the stimulus is just what the fiscal deficit is, and not just the expenditure component of it, then the fiscal position is going to be expansionary in the sense that revenues will be lower. But there's a big difference between a fiscal expansion caused by lowering tax rates when income remains the same, because then you're really transferring the tax revenue from the government to the public and the public spends.
Right.
As opposed to a situation where income has collapsed and therefore tax revenues are lower. The fiscal deficit is higher, but there's no expenditure taking place because incomes have collapsed. I think Subba made a very important point, which I should have emphasized myself. A 6% or 5% drop in GDP is not a 5% drop in everybody's income. It's going to be a highly differentiated impact with the poor, the informal sector, unorganized labor experiencing the worst impact. On agriculture, he said it's going to be a good harvest, and I hope so. But you're going to have a pricing problem, except for cereals, where if you produce the grain, the government will buy it. Everything else depends on market offtake. And if there are restrictions of movement, logistical problems, this, that, and the other, many farmers who have a good production may find that the prices that they are getting for it, and milk is one example, may be much lower. So what it does to their income in current terms is questionable, even if in production terms they're doing well. So I think you've got all these problems to worry about, and they translate on the other production side to what will be the impact on businesses.
Sure.
Because again, the RBI has done a very good job, in my view, of expanding liquidity. But the businesses that we're talking about are really finding their margins squeezed. So
Sure.
in a way, they may not even be solvent. So, taking on debt, if the business is not solvent, doesn't actually make much sense.
Right.
Banks are very unlikely to lend. In any case, the small businessmen didn't depend on banks. They depended on the NBFCs.
That's right.
They cannot be forced to lend because government says something. So I think we've got a crippling effect on business that somehow would come out more clearly if the government were to say it's going to be 5%, or if not 5%, they can say 4% loss of GDP. Therefore, our fiscal deficit is going to be this much higher. This is the stimulus on expenditure that we've given, which is actually quite small. On the expenditure, it's about 1% of GDP, and we've expanded potential credit hugely. Then one can debate and discuss whether the expansion of credit is going to lead to a picking up of activity. And one of the problems there, by the way, is that you're all assuming that when the lockdown is lifted, the economy will get back to normal. But elsewhere in the world, the lockdown is being lifted at a time when the new cases are coming down. Right. That's not the case in our situation.
Absolutely.
So I worry that when the lockdown is lifted, suppose the number of new cases shoots up. Now, maybe because we are testing more. Is it the policy that we are now ready to face the higher incidence of infection? And we're not going to reintroduce a lockdown? Or is the lockdown going to get reintroduced? We need some clarity on that. No, business is not going to ramp up production if they're not sure of what government is going to do. And I realize it's difficult to do, but the more government comes out and says, look, this is how we see the situation, this is how we're going to behave, we would be a lot better. Let me just give one example. The logic of the lockdown was not that it would stop the infection. The logic of the lockdown was that it would give us more time during which we build up health capacity. We don't even know how much health capacity we've actually built up.
Sure.
I mean, there's a lot of talk, for example, of shifting beds to COVID cases. That just means that people who have heart attacks and cancer will not be given admission, and COVID cases will be given admission. So, you know, all of this needs to be clarified to a much greater extent. And I'm not saying, by the way, the government will be able to give clear answers, but it'll lay out the stake posts for judging policy. We don't have that information.
Absolutely.
Yet.
Well, you make some excellent points, Dr. Ahluwalia, and we will build on a lot of them. To start with, maybe some clarity around the thinking would be very useful for businesses and all of us as well going forward, and we will build on these points. You also made the excellent point on the nature of the fiscal deficit and what we're looking at. Dr. Subbarao, before I go into short-term steps, a lot of which, by the way, Dr. Ahluwalia has already built on, you mentioned financial stability, and you've been central bank governor. You know the brass tacks. How worried are you about the health of the financial services ecosystem? Because as the economy takes a beating, that's one sector which is clearly going to be very vulnerable. So as we head into what we should do for the short term, how much do you worry about the health of the financial services system? And the same question that I asked Dr. Ahluwalia, is it fair to expect a quick recovery? Do you think workforce comes back? Do you think activity can start again, maybe in 2 or 3 months' time?
Thank you, Ananth. On the financial sector, it's quite worrisome. In fact, if you throw your mind back to January before the crisis, the COVID crisis hit us, we were extremely worried about our financial sector, about the health of our banks, about the health of our non-bank finance companies, NBFCs, about the level of non-performing assets, about the trust deficit, the phrase that you use quite commonly, a trust deficit in our private sector banks. So we were worried about all of them. And all those parameters are going to get worse as we come out of this crisis. And the financial sector, which was in deep stress, will be in deeper stress. The non-performing assets level, which is about 9 to 10% in January, will certainly shoot up, and some estimates are that it might actually double to 18 to 20%. That's quite worrisome. It'll be quite a challenge for the Reserve Bank, for the government, for the banking system, for the entire financial sector to come back and to repair the imbalance that creeps into this. You know, before whatever happened before this COVID crisis hit us, we could look back at ourselves, regulators, government, policymakers, and say, where did we go wrong? But what's happened since, say, mid-March to now is entirely because of a force beyond anyone's control. It's come from outside of the economic and financial system. So I think the Reserve Bank and the government and all regulators will have to be deploying their mind, using their experience, wisdom, to ensure that they navigate, they engineer getting the financial system back to stability. That's a very unprecedented challenge, because what's happened to the financial sector is because of something that has hit us from outside the financial system.
Right.
Now, to your second question about the recovery, what should we do in the short term? Like millions of others, I heard the Prime Minister talk about his 20 trillion rupee stimulus package. I heard the Finance Minister explain that over 5 extended sessions. And like everyone else, I tried to make some sense of that. But if you go behind all that and say, what are the objectives that the government was driving at? I see 3 things. One is they were trying to navigate the economy through this survival phase, when we're still struggling with the high incidence of the pandemic. and when we're still under a lockdown and when we're still worried about reopening the economy. That's managing the survival phase. Then I think they were targeting what happens once the lockdown is eased and the economy has to restart. What sort of stimulus do they have to give? The time for stimulus is not now, but the time for stimulus is when the economy starts getting back on track. Right. What sort of stimulus do we give to consumers? What sort of stimulus do we give to producers? I think that is the second strand of that package. The third strand of the package is somewhat medium term, a reform package with the hope, expectation, objective that it'll get India back onto a growth trajectory that we saw some years ago, that we can get to a 5 trillion rupee economy sometime soon enough. So how do we do that? And the rationale for including that now, even as we're in the middle of this crisis, I believe, is to inspire the confidence of the market that India has not only a short-term plan, but a medium-term plan. And I think that was very important. So a survival phase, a growth revival phase, and a high growth trajectory phase. That's what I thought the 20 trillion stimulus package was driving at.
So yeah, go ahead, sir.
No. I just wanted to say that the stimulus is not now, but a stimulus will be very, very important, both for consumption and for production once the economy is restarted.
So let me ask the inevitable tough question to you first, Dr. Subbarao, and then I'll come to Dr. Ahluwalia. You described the package very well, short-term steps, medium-term steps, both put together. How would you rate it in terms of giving humanitarian relief to businesses? Has it done enough? Are there other suggestions you would give around that?
That's a very, very wide canvas question. But yes, if you want me to give a short answer to that, within the constraints of the government, within the fiscal constraints, I believe they've done a reasonable job. The government has been criticized for not borrowing much more. I, for one, believe that the government should borrow more in order to spend more. That's a moral imperative, that's a political imperative. But I do not support the view that the government should resort to open-ended borrowing. Our government cannot say that we're going to borrow whatever is necessary because we're going to spend whatever is necessary. I don't support that view, because it's very important that the government set itself a limit. And I think they've been quite wise in setting themselves that limit, that additional borrowing will be 2.1% of GDP. Perhaps that will have to be increased later in the year. But for now, they set a limit. They've given some number to the market so that the government is accountable, is efficient, and it can be held to account for what they're doing. So the answer to your question is, given the fiscal constraints, the government has done a good job of leveraging a large enough package out of very limited resources. I take the point that Dr. Ahluwalia said that the government must say what the fiscal deficit is going to be this year. I think it's very difficult for them to say that right now because they don't know how this is going to unfold and unravel in the months ahead till the end of this financial year. But within the universe of knowledge available to them, I think they have done a fair job in saying that for now, the additional borrowing will be 2.1% of GDP, leaving open the question that there might still be additional borrowing beyond this, even within this fiscal year.
Thank you, Dr. Subbarao. Dr. Ahluwalia, same question to you. There is humanitarian distress. Have we done enough to alleviate that? There is business and economic distress. Have we done enough to alleviate that through this 20 trillion rupee package? And a follow-up question to what Dr. Subbarao said and what you said earlier, if you were Finance Secretary or Deputy Chairman of the Planning Commission, what would you reckon is the space available on the fisc to spend on humanitarian or economic relief right now? How do you determine that magic number of how much you can stretch the fisc?
Well, that of course is what they call the $64 million. I suppose they should say 64 billion, because million is no longer. That's the big question. Let me put it this way. First, the actual fiscal component of the package is about 1% of GDP. Yeah. I don't think that's actually enough, given the distress that's been caused. I can see Subha's point that if you view it as this is what we're doing now, and you do more later, then of course one must revise one's opinion. But in my view, if we are into a -5% of GDP roughly, which will be a huge hit on the poorer population, then a pure 1% additional expenditure component is not enough. Incidentally, if you compare across countries, while 10% of GDP looks pretty impressive, the pure fiscal component is actually one of the smallest, even compared to other developing countries. Then, I mean, the question, do we have the fiscal space? Now, you know, we don't have the fiscal space if you look at whether we are fiscally in a good situation. You know, when the present government, the first NDA government took over way back in 2014, the idea was they wouldn't get back to the fiscal deficit of around 3% within a year or so. That was never achieved. And, you know, there's a lot of fiscal fiddling and so on. And basically, we've not created space in the last 5 or 6 years. But even if we have not created space, if we feel there's a humanitarian crisis and you want to put in another 1% of GDP on top of everything else, I think you have to look at fiscal space in 2 ways. One, is that going to crowd out private investment? Because if you take up 1% of GDP and spend it in some useful ways, and that crowds out 1% of private investment, you could say that you're losing a lot of positives. Therefore, you're misusing the limited fiscal space. Now, in my view, this year, there's no chance of private investment. So what you would be doing, actually, is you'll be entering the next year with a higher debt to GDP ratio than is ideal. But, you know, if from next year onwards, if you actually had a policy that would bring the economy back to growth and move to fiscal consolidation from next year onwards, you could very easily show that over the next 3 or 4 years, we bring the fiscal position into a reasonable one. So the real question is, do we have that kind of fiscal commitment for the next year? Forget about the current year, for the next year. And do we have the seriousness to bring about the kind of reforms we need to get the economy going again? Now, there are huge questions on that. There always are. But
Sure.
we need a clearer debate. What is our fiscal strategy for the future? Are we going to cut down useless subsidies? Are we going to do a major tax reform? Are we going to remove some of the leakages? Now, I have said on earlier occasions, you mentioned that this is a 1991 moment. Where it can be a 1991 moment is we just recognize that we haven't really had a serious tax reform since the Chellaya committee was appointed in 1991. You said, what would I advise? Well, what I would advise is we should now set up a truly high-level, multidisciplinary committee of people advising the kind of tax policy to be announced in the next budget. Hopefully by then, all the current problems of COVID control, et cetera, will be taken care of. And that should include a serious re-examination of the GST, where there are huge leakages taking place. For a variety of reasons, the original design has been completely mucked up. Now, do we have the courage to get up and say, look, we've done the constitutional amendments, so it's possible now to just restructure the GST. If we can go to all the states and say, look, this is a key moment, I think it can be done by setting up a non-governmental committee. I would very strongly say that leaving this to the bureaucrats within the ministry, who are the ones who've given you what the GST you've now got, is to expect them to say, oops, I'm sorry, we got it all wrong, is just not being realistic. Bring in some people who understand business, bring in the sort of tax experts who advise business how to take advantage of loopholes, bring in some top-level economists and produce a first-rate report, and then open it up for discussion. And by all means, reject it if you don't like it. But at least it will give a sense that we are listening. That's one thing. Second, and I think this is very important also, you know, for years we've been saying we have a multiplicity of subsidies, which are actually counterproductive. Are we willing next year to say, this is a 1991 moment? Now in 1991 moment, by the way, we didn't do very much on subsidies. We ducked that one. But we can't keep ducking that one now. So are we willing to do something on that? This is a second. The third, and in my view, very crucial issue is the threat of rising protectionism. I mean, around the world, the loss of confidence in globalization has led to a more nationalistic policy everywhere. Right. So if we were to fall into that trap, you could easily defend it. But my personal view is this would be a mistake. We are certainly not going to go back into the kind of gung-ho globalization that existed earlier. But the idea that we should erect protectionist walls and that we will find our salvation through self-reliance is, I think, mistaken. This is not an issue on which there is agreement. Many people would say that, no, the time has come, we must do it differently, etc. This needs to be discussed and debated. So how open we are going to be. Now, for example, I was very disappointed that after having given every signal that we are going to join the regional cooperation, economic partnership with the ASEAN countries, we withheld our signature. Right. Now, we cannot seriously expect to join global supply chain, which I think the Prime Minister has said we should, which is good. We cannot seriously expect that if you're not willing to join the one part of the world which hasn't yet gone protectionist, which is East Asia. And this is also the geopolitics of the future. East Asian countries would be much happier to have India inside, if only as a bit of a counterpoise to China. I mean, we're very small compared to China. But if we're not willing to do that, we're simply not facing up to the kind of trade policy that is necessary in the years ahead. Again, controversial, but in my view, not being adequately discussed. Sure. So I think we need to go into these things. The bottom line is, if we can transit, I don't think, by the way, we can get back to 8% growth. The world normals are lower. But if India, with strong reforms and a trajectory of fiscal responsibility beginning next year, could hope to bring it back to 7% growth, then I think the debt to GDP, one can show that the debt to GDP ratio will go down. So the fiscal space problem isn't there. And the real question is, what specifically are the reforms you want, and are you willing to do them? And I think that's where we should be concentrating between now and the beginning of next year.
That's an excellent overview, Dr. Ahluwalia. So that's great points out there. Comprehensive tax reforms going beyond GST and the direct tax code, relook at subsidies all over again. Third is this whole question of the international interfaces, globalization, etc. All of that into a broad policy of how do you manage the fiscal deficit going forward as one way of making sure that you're on the right path. Thank you for that, and we'll revisit some of this, but I'm going to pin you down a very short answer to a short question. How much more fiscal deficit spending would you encourage right now, and in what form? Where do you think is the deficiency?
Well, I think that up to an additional 1% of GDP, which is aimed at dealing with these extreme distress situations, and maybe a little bit more on the health side can be done. In my view, we should put that in a global context, that a lot of the so-called fiscal deficit increase is going to be tax revenues and no disinvestment. And we can only take care of that in future.
Fair enough. So 1% more right now, but with a plan around how do you handle the fisc going forward and address this overall issue through reforms. Thank you very much. Dr. Subbarao, I'm going to come to you now on a totally different topic, monetary policy. We've seen the RBI be and the MPC for that matter, use a lot of conventional, unconventional steps. They've flooded the market with liquidity. Banking liquidity is at all-time highs. They've cut rates by 155 basis points. Overnight rates are even lower than that. Repo rates are below 3% at this point in time. Couple of quick questions. One is, do you endorse these steps? Do you think these are the right steps at the right time? Two, what is the efficacy of these steps at a time like this when there is no demand around? Do we really need to keep beating the monetary easing drum at times like this? And third, of course, is what else would you suggest for both for Governor Das as well as for the MPC going forward basis?
Well, your first question is about, are these the right steps? We've seen that in every crisis, no matter what the cause of the crisis is, if it translates into a financial crisis, it is incumbent on the central bank to inspire confidence in the markets.
That's right.
And in order to keep that confidence, it is necessary for the central bank to cut rates and inject liquidity, which is what the Reserve Bank of India has done, indeed much less than what other central banks have done of advanced economies. But given our own situation, I believe that the Reserve Bank of India has fired quite vigorously. Like you said, they've cut rates, they've injected liquidity, they've tailored schemes quite innovatively for specific sectors. For example, the NBFCs, MSMEs, large corporate sector, housing finance companies, mutual funds. They've given regulatory forbearance for repayments, etc., all within some logic. So I believe the Reserve Bank has done much more than what it needed to do, and that's all good. We must also recognize one thing, because it's quite common in these days to refer what the Reserve Bank or what any central bank is doing today compared to what they were doing in 2008. I think the role of central banks in this crisis is quite different from what it was in 2008. In 2008, it was a financial crisis. When confidence in the financial system, faith in the financial system was broken. People stopped spending. Therefore, financial system collapsed. What was necessary at that time was to restore confidence, restore faith in the financial system. Therefore, central banks were out there in the forefront. They were actually the warriors on the forefront. Right. In this crisis, on the other hand, the origin, as I said earlier, is from outside the financial economic system. The solution has to come from science. Meanwhile, what central banks are doing is just doing holding operations. So that perspective, I think, is very important to understand what central banks are doing, what the Reserve Bank of India has done. So the answer to your first question is that the Reserve Bank has done quite a lot in conventional sense. The second question is, has monetary policy lost its traction? You know, one thing about this crisis all around the world is that fiscal policy has no room, but it has traction. Monetary policy has room, but it has no traction. That is the same with the Reserve Bank of India as well. You know, they've cut rates, they've infused liquidity, but lending is not happening. Because the binding constraint to lending today is not the interest rate, it's not liquidity, it is risk aversion. And the Reserve Bank has tried all it can, but it is not able to break that impasse. That is why it's important for the government to come with, in its stimulus package, with guarantees and liquidity managements, etc.
Sorry to interrupt you there, sir, but do you think that's enough, what they've offered in terms of guarantees and
about the fiscal package?
Yes, sir.
Oh, well, okay, now you're asking me to shift from monetary to fiscal. Okay, I'll do that. You know, as I said earlier, within the fiscal constraints available, they've done whatever. Like Dr. Ahluwalia could argue that you could spend 1% more on livelihood support. Perhaps you could spend 2% more on supporting the production sector, large corporates as well as MSMEs. But I believe the time for that is not right now.
Fair enough. Let's bring you back to the monetary policy. Apologies for the diversion.
No, not at all, not at all. It was a good juxtaposition from you. So the monetary policy, the returns to monetary policy, the marginal returns as we see are diminishing because it is not monetary policy per se that is the binding constraint. Right. So fiscal policy had to come. So if I was to, you know, advise the RBI, because I don't advise the RBI, they don't see my advice. But, you know, since you asked, I would say keep your powder dry.
Right.
Since you've deployed quite a bit of your weaponry and you've seen it, and you don't know how this pandemic is going to unfold, whether it's going to be a V-shaped recovery, W-shape, U-shape, L-shape, or whatever. It might come back later in the year, in December. So keep your powder dry. You know, use whatever ammunition you have with some caution.
Thank you very much, Dr. Subbarao. That was fantastic. Now, we will move on to the last phase, which is the medium-term steps and the institutions. But before that, a very short answer from both of you. As Dr. Ahluwalia also mentioned, we don't know how the medical situation will turn out. We are still watching that unfold in front of us. Where would you stand on this rhetorical lives versus livelihood debate? God forbid if we have to make that choice again, now we're opening up, where would you stand? Do you think the medical consideration has to take precedence, or would it be economics now? Dr. Ahluwalia, why don't I start with you?
Well, that's a very difficult moral situation, and one needs to have an assessment from medical people on what would be the impact. And the real question is, when will lockdowns actually lead to saving lives? I mean, right. I think the difference between our situation and the rest of the world is that given the conditions in which a very large number of our population live, especially in urban areas, in the slums, it's not clear that a lockdown enables you to maintain social distancing. So it's quite possible that if you have 10 people crowded in a room, then compared to the social distancing they can maintain if they're all working, they may actually be able to do better working than if they're crowded in a room. I mean, the assumption of a lockdown is that if you're in your own home, you are protected. That is very true if the infection is located amongst a few foreign-based carriers.
Sure.
Once it spreads, then I'm not sure that that is going to be a correct solution. But really, it's the epidemiologists who should actually be telling us that now that the lockdown is being restricted, do they expect the number of new cases to increase? My guess is they will probably increase, but partly because we're doing more testing. Earlier, we weren't testing.
Sure.
How much of an increase are we willing to tolerate before we reimpose the lockdown? That's also not clear. And I'm not expert at it. So I think this is an area of uncertainty, and we'll have to live with that uncertainty.
Fair enough, sir. Dr. Subbarao?
Yeah, I'm not an expert either, but let me give my 2 bits. As you said, Ananth, that this lives versus livelihoods has been an issue that's been quite common in public policy discourse during this crisis. Every government battling the crisis is confronting this dilemma, lives versus livelihoods. As Dr. Ahluwalia said, where a government strikes the balance between lives versus livelihoods is different for different countries.
Right.
Take a rich country, for example, they can afford to put an enormous value on life. Because if a person loses livelihood, the hardship is not as intense as in our country. For example, a woman loses a job in America. She's going to cut down her discretionary spending, her quality of life might come down, but she's not going to struggle for food, she's not going to struggle for livelihood, she's not going to struggle for shelter.
Sure.
Whereas in a country like ours, loss of livelihood can mean running down your savings, then poverty, then destitution, then starvation. So in a rich country, they can afford to tilt towards life as opposed to livelihood, whereas in a poor country like ours, we tilt more towards livelihood versus life. I also want to make another point, which is that our own estimate, given India, given our own country, our own estimate of this balance has shifted over time.
Sure.
Throw your mind back to March 23, eve of the first lockdown. Right. Most of us thought, okay, we will endure this 3-week lockdown. We will sacrifice livelihood for a bit of life. Okay. But now we know that we've got to live with this for a few months, perhaps a few years. So our own estimate of where to strike the balance between lives and livelihoods has changed. Now the current thinking, in my view, that's quite right, is that yes, we cannot afford to be spending so much, putting so much value on life, because we need to be looking after livelihoods as well. So let's move on with life, and let's move on with our livelihoods, and let's hope that the pandemic will come to a low-level equilibrium so that we can manage it with minimal loss to life.
Thank you, sirs, both of you, for a very, very nuanced set of answers. Slightly different in the context, but I think it's very good perspectives. Let's move on to the medium term and to institutions now. Let me start with you, Dr. Ahluwalia. You made the passionate case for having a kind of a roadmap for fiscal, bringing back the fisc into control. Let me throw this almost silly question, which is economics changing? The whole world seems to be printing and spending. Has economics changed to an extent where sacrilege, we can actually think about getting away with a bit of fiscal surpluses and excesses and monetary excesses? What is the cost that we will have to pay in your reckoning eventually for fiscal excesses and monetary excesses today?
I heard you say fiscal surpluses.
Excesses.
Fiscal surplus. Yeah. No, look, I said that earlier, that you're right. that the rule book has, if not been thrown out of the window, it's been put at the back of the bookshelf.
That's right.
So I firmly believe that what we do in the current year, within reason, I think Subba, as a former governor is always very good at providing the balance. And I want to enforce the proposition that this should not be viewed as an open-ended invitation that all conventional wisdom is irrelevant. Let's print and spend like mad. No. But I think that we could, in my view, justify a little bit more spending. Subba is right that you want to keep your powder dry, so you don't want to exhaust everything. But like I would have said that, you know, we would say that, look, this is the first batch of support. If GDP does not recover by the second quarter to a certain amount, there'll be a second batch of support. So, you know, you can give a nuanced way of reassuring people that more is coming. At the moment, there's complete uncertainty. Right. And I think that's not good. That's point number one. But, you know, we need to take that into account. How much can we get away with? Well, as I said, that depends entirely on A, the fiscal strategy and the credibility of the strategy from next year onwards, and B, the medium-term reform strategy from the next year on. Because remember, we can be very fiscally responsible and end up with 4% growth, or we can be a little bit more irresponsible this year and then do a whole lot of things that might take 4% to 6%. The second outcome will actually lead to a better debt to GDP ratio 3 years down the road. Sure. And I don't think that the government seems to be worried about what the financial analysts are saying. But I think financial analysts understand that. What the financial analysts are really worried about is that we don't have any discipline fiscally, and no government has had, I mean, even in the past. And there is no political pressure to keep the fiscal deficit down. I mean, if you ever become finance minister and you make a speech in parliament saying you're increasing some expenditure by 5 lakh crores, you can be guaranteed loud applause in parliament. That nobody will get up and say that you're just jeopardizing our future. So we don't have, our political system does not give the kind of signals that would make governments more responsible. In fact, the fear is always the financial analysts. I mean, this is why one of these well-known financial people said that if I'm born again, I want to be born as a bond market, because that scares everybody. It seems to be true even here. But I think this time they're wrong. Right. We could explain a package, but it has to be a package. We can't say we'll do that later, and we're not saying anything about it now.
Right. Dr. Subbarao, same question to you. Right now, there isn't any sign of demand-led inflation because economic growth has come down quite substantially. As I think you mentioned, as one of the positives, the currency is being reasonably well behaved. In fact, current account deficit is probably going to be a current account surplus for the wrong reasons, but nevertheless. So neither currency nor inflation seems an immediate threat. Are we being too pedantic when we say that we need fiscal rectitude on an ongoing basis, that we have to have some strategy for fiscal discipline going forward? What do you think is the price we have to pay for printing and spending? And I know you're a big votary of not printing and spending excessively.
But let's look at the historical experience. Sure. I know textbook knowledge as well as what we've experienced ourselves. What does excess fiscal profligacy lead to? It leads to crowding out private investment, which can dent our growth prospects. It can lead to balance of payments pressures. Our bruising crisis in 1991, as well as the near crisis in 2013, are a consequence of extended fiscal profligacy. It can lead to extended inflation. The inflation that we saw after the global financial crisis was in fact a result of excess fiscal profligacy. Now, there is enormous justification today for not throwing the rule book out, but bending the rules in order to borrow as much as possible today in order to avert the crisis. But no matter what we do today, we have to take into consequence what will happen tomorrow because of what we do today. We can't just look at today in a silo and say, I'm going to do whatever, because we have to look at tomorrow. We're not all dead in the long run, as Ken said. So if you believe that we're going to be alive, we've got to look at tomorrow. Let's just look at, taxing today or borrowing today. If you're taxing today, you're taxing today's people. If you're borrowing today, you're taxing our children tomorrow.
Absolutely.
So how do you draw that balance between how much do you borrow, how much do you tax? So the general point I want to make is that whatever you do today, you got to be conscious of the medium term and long term consequences of what we do. So as far as fiscal profligacy is concerned, I hold the view that yes, there is enormous justification for borrowing more, borrowing much more, but not very much more.
Right.
Within limits, within transparent limits, within limits that are shared with the markets, shared with the public. There is a case for borrowing more, both for livelihood support as well as for giving stimulus. But that's got to be within limits. Only when there's a limit will the government spend the money efficiently. Will the government be accountable? So I believe that there's case for doing more, but within limits.
Very short question, sir. Do you think there is a case for the RBI to directly monetize the government spending by going back on FRBM and starting to do primary auctions of the government?
Well, I can't give a short answer to that. No, I can't give a binary yes or no answer. But if you press me, I will say that there is no case for monetization. Okay. But what's the case for monetization? What are people are saying that the government has enormous borrowing this year, and if there are not enough savings in the economy to finance that borrowing, say government borrows that in the open market, yields will spike, and there'll be financial instability. That's got to be prevented. Therefore, RBI needs to step in, print money, and give it to the government. Yeah. But we're nowhere close to that. If you look at yields, the yields today are about 6%, inflation is about 6%, which means that the government is actually able to borrow 0% in real terms or at close to 0%.
Right.
Yields will actually soften. They were 8% last September, they've softened to 6% now.
Right.
And even on the day the government announced additional fiscal borrowing of 2.1% of GDP, yields settled at 6.2%. Right. So I don't believe we're anywhere close to the requirement or a necessary condition for monetization. We might get there sometime, but I don't believe we're anywhere close to that right now.
Very well argued, sir. Thank you very much. Dr. Ahluwalia, I'm going to come to you. We're talking about reforms. The Prime Minister spoke of reforms as well, the 4 Ls and all of that. You laid out a very good set of areas for reform, whether it's re-looking at the tax code, whether it's re-looking at subsidies, whether it's re-looking at the global supply chains, and so on and so forth. Here is a broader question to you, sir. We seem to be struggling in creating jobs, jobs and output. Somehow we seem to be having periods of jobless growth. How do we solve this? A lot of the metrics around jobs and employment don't look great either. What reforms are required, you think, for us to have sustainable jobs being created so that we can have sustainable output as well?
Well, as you said, the jobs issue has been a problem even before the COVID crisis.
That's right.
Even in the period when growth was good, jobs were a problem. Now, there are 2 dimensions to the jobs problem. I mean, one dimension is the growth of formal sector jobs, and that has been very bad. Even in the formal sector, when employment expanded, the expansion was of informal hiring of labor on a contract basis rather than creating regular employment. The short answer to your question is that I don't believe that there is a solution to the employment problem which is actually different from the solution to the medium-term growth problem.
Got it.
I do think the critical thing is that we should not be thinking of a growth strategy which is dependent only on high-end, highly capital-intensive, and high-skilled labor kind of growth. That's important. We have scope there. We should explore it. But it's really in the rest of the manufacturing and indeed even services sector, middle-scale businesses need to expand. Now, these are the businesses that can provide decent jobs. Right. But a lot of the businesses we have, which provide a lot of jobs, are actually providing very low-quality jobs. And that, I mean, we have this category called micro, small, and medium enterprises.
Right.
And, I think we need to recognize that the role of micro enterprises generally are just a combination of just defensive self-employment, where people are working for very, very low salaries, and some entry point of new guys who will quickly move up the ladder. we need to create what is called in India the missing middle. We seem to have a fair number of larger firms and a huge number of small firms. You know, a lot of the current crisis is actually going to create a bit of winnowing out, because in what we call the middle small enterprises, many of them will not actually be able to get credit. The additional liquidity that's being provided is more likely to go to those in the middle sector whom the banks are willing to lend to. And with the NBFCs in deep trouble, many of the smaller enterprises may not be able to find. So you may actually find in the short run a worsening of the employment situation.
So sorry to interrupt you, Dr. Ahluwalia, but can I ask you this? 3 states have announced relaxations in labor laws. So there is something that seems to be cooking, both in terms of making land available, land banks available, as well as easing up of labor laws. Do you think that's the right way to go eventually for creating jobs?
On the land side, 100% the right way to go.
Right.
You know, on the labor side, I mean, I think rather than simply make all labor laws inapplicable, there are many aspects of labor laws that don't relate to inflexibility.
Right.
To my mind, abolishing all that seems to be an overreaction.
Right.
I think there are things we can do to increase the flexibility of employment so that people are not discouraged from converting the current informal sector people employed into more formal. But you know, whether that needs to be done right now or after a little bit more thinking. After all, the present position is that the economy is not able to generate the employment it was generating 6 months ago.
Right.
That's because of a disruption. Now, we need to fix the disruption. To react to by saying, let's get rid of all the labor laws, seems to me a bit of an overreaction. And you know, please, we have to remember, I mean, social harmony is a very important part of any kind of healthy growth. And one of the problems with globalization and capitalism and all the rest have produced is a perception that the gains are unequal. And that's broadly true. Now, if you include that, we include in that a perception that the government is quite willing to trample all the rights of labor, you are worsening you're increasing the possibility of social disharmony, which I don't think in the long run is a good thing. But I do agree, what investors would be most impressed by is an assurance that the flexibility of labor hiring is being increased, plus a huge ease of doing business. I mean, you know, that was promised. I don't know where those things stand, but anything that massively simplifies and reduces compliance burden would be very welcome, and it should be done. I mean, it can be done by ordinance. It doesn't have to wait. And then get converted into law.
Right. Dr. Subbarao, I'm going to come to you. Any comments you want to add on this job thing, more welcome, more than welcome to add. But I'm going to ask you a larger question on the financial sector. There are a few questions which have come up on the chat as well, so I'm going to read them out to you. One is the unthinkable questions. Can state governments actually default on their bonds? I'm going to ask you that question anyway. That's one. But more broader questions, sir. You talked about the state of banks and particularly NBFCs even before COVID-19. How do we get out of this? What is the way out to reform and rejuvenate our financial sector? So weighty questions to you, sir.
There are 2 different questions. First, let me make a comment on the employment situation on the reforms. I can't add much to what Dr. Ahluwalia put across so articulately. But I do want to say this. As much as structural reforms, labor, investment, whatever is necessary, we must also place equal emphasis on governance reforms.
Right.
It's okay for good policies to be made in Delhi or in state capitals, but those policy implementation completely not completely, but largely breaks down at the frontier level. We've improved quite substantially over the last 6 years in the World Bank's Ease of Doing Business Index. We were at about 125, 2014, in 63 or whatever.
Right.
But anecdotal experience is still the same about investors, entrepreneurs being frustrated at the front end. So what this means is that we need governance reforms which will ensure that policies being made by the central government in Delhi and policies being made by state governments in the capitals are actually translated to the front end. So I think we should concentrate on governance reforms as well. On jobs, I want to make a comment about, just this, that it's, as Dr. Ahluwalia said, it's a structural problem and it's got much worse because of this disruption caused by the crisis. And, people talk about a demographic dividend, India getting a demographic dividend, which says that, look, we've got a young population and they will earn, save, that's then return into investment, that'll generate growth. But demographic dividend is not going to come unless we create jobs.
Right.
And jobs are not going to come from agriculture. Jobs are not going to come from the services sector. Jobs have to come from the manufacturing sector, especially, as Dr. Ahluwalia said, in the MSME sector, in the missing middle, and indeed even from the micro enterprises and informal sector. Now, as far as the financial sector is concerned, the first question is, can state governments default? In theory, they can, but in practice, they will not be allowed to. Because the government of India will ensure that some relief is provided to a state so that it does not actually default. A little known clause in our constitution, never been invoked, is that central government can declare a financial emergency in a state. I don't know why they put that clause, because if a state goes into an excess, it becomes central government's baby, because they actually declare a financial emergency, whatever the state government excess has been will translate to government of India. So in any case, government of India will make sure that the state does not default. And if a state goes into chronic default, then it's going to get to all sorts of problems. So technically it cannot, in theory it cannot, in practice it will not be allowed to default to the extent possible. Okay.
Right.
On the health of the financial sector, on the health of banks, non-bank finance companies, just like our fiscal deficit problem, just like our jobs problem, there is no easy answer to this. Right. We know that there's a level of non-performing assets, which, as we talked about earlier, that's going to double by the time this crisis is over. I hope that is soon enough. But the regulator has got to adopt a differential approach to those loans which are bad or unviable even before we enter the crisis, and those which have become unviable because of this crisis.
Sure.
And hold their hand, provide them restructuring assistance. If we do that successfully, what it means is that we will reduce the problem to the level we were saddled with in the month of January. And that requires the long-term solution. The IBC bankruptcy code that hopefully will be on faster track now onwards. But we now know that we can't load the IBC with every bad loan. There's got to be mechanisms for settling that outside of the IBC. And that there's a question of whether we set up a bad bank or whether we give some other mechanism for each bank to settle the bad loans. But we got to handle that much more vigorously with much greater attention by the Reserve Bank and the government together than they have before the crisis started.
Thank you, Dr. Subbarao. Yeah, go ahead, please.
Non-bank finance companies as well. You know, they add enormous value. In fact, a lot of people have asked me after I left the Reserve Bank about why the Reserve Bank is a stepmotherly attitude towards non-bank finance companies. That is not in fact true. I know from my experience within the RBI that the RBI attaches enormous value to what the NBFCs are doing. And they value a differentiated regulation for NBFCs. You know, after the financial crisis, the catchphrase was that if something is behaving like a bank, regulate it like a bank. I don't believe we should do that. We should give a differential treatment to non-bank finance companies so that they can continue to add value to our economy.
Great. So you do see a future for NBFCs as distinct from banking. Thank you very much, sir. Dr. Ahluwalia, in case you want to add something on the financial sector, and then I'm going to pop a next question to you along with that, which is, you know, to resolve weighty issues, both short-term as well as medium and long-term, A, there has to be an acceptance of the problem, and B, there has to be a consensus around the solutions, and C, you've got to have a good team capable of execution. Do you see those ingredients in place as we go through and wade through this particular crisis?
Well, on the issue of the banking, I think Subba gave a very good account of the problem. It is structural. It's been there for a long time. The only thing I would add is that given the nature of the problem, and given the fact that large proportion of the banking system is public sector, recapitalization of the banks is an essential part of fixing the NPA problem, and the NPA problem has only increased.
That's right.
I think the government has not in the past recognized the extent of recapitalization. And if you recognize the extent of recapitalization, I mean, it kind of forces you into one of two directions. Either it forces you to accept the fact that the recapitalization is going to come from the market because the government's share of equity is going to go down below 51%, or it forces you to say that the government is going to recapitalize to maintain that 50% level. If you do the latter, then your apparent fiscal space is reduced that much. Right. I'm actually in favor of making a very clear statement that yes, this is the recapitalization we need. We are going to do it. It means that we'll have to borrow more. Maybe there's the old business of whether this can be done by a sleight of hand.
Recap bonds.
Which is the RBI gives special dividends. But frankly, from a monetary point of view, those are identical. But whatever it is, we should recognize this and say, well, look, beginning next year, when everything is taken into account, this is the debt to GDP ratio. And that creates the seriousness of commitment to the fiscal correction needed over the next 3 or 4 years. I mean, if we hide this, then we understate the amount of correction needed. I think that's the critical thing. The second, Subba mentioned whether it's by setting up a bad bank or not. I'm in favor of setting up a bad bank. I mean, for the simple reason that if banks have to recognize the need for a haircut, they're not going to do it themselves because they have in their files all kinds of justifications why the business concern can actually pay up. Sure. And it's virtually impossible for the same management to say, well, actually they can't, so we're going to take a haircut.
Right.
If you set up a bad bank, different management, they weren't responsible for it, whatever. Even the banks may be more willing to accept a low valuation on the loans because it's a low valuation being given by a government set up bad bank.
That's right.
And I think that leaving it to the banks is not going to work. That's why the NCLT was set up as another way, because the banks would say, well, we don't think we want to accept a haircut, but let's go down the NCLT route, and that's transparent.
Right.
With the present situation, that's not going to be very effective. So, sure. Short answer, better think of a bad bank.
Right. On the preparedness for reform, sir, have we acknowledged the problem? Do we have a solution set? Do we have the right team in place, you reckon? Are you confident about all the steps that we've been discussing so far being done?
I don't believe that the nature of reforms that we need has actually been discussed. What has been said is that we need reforms, and some pillars have been mentioned, but the details are not there. Let me give you a very simple example. We are saying on the one hand that we must strengthen self-reliance. The word self-reliance sounds very good because, I mean, who doesn't want to be self-reliant? It means being strong, being able to tackle your own problems, etc. Some people interpret that to mean more protection, raise import duties. Other people say, well, we want to do self-reliance, which is actually consistent with joining the global value chain. That is not consistent with raising import duties. So what is happening is, from the articulation of a headline of reform are coming very different policies. So I think we need to be clear on what the rationale is. And only then could we make up our mind whether we are heading in the right direction.
Thank you, sir. Dr. Subbarao, a different form of the same question to you. There's a fair amount of uncertainty, as Dr. Ahluwalia also mentioned, around the actual fiscal deficit numbers, around the actual NPA numbers, especially for NBFCs as well. There is lack of complete transparency. Do you think we're not seeing the trouble for what it is? Are we having trouble in recognizing what the real issues are? Can we handle the truth? Can I ask you that question?
Well, I'm not inside the government now, so I really don't know what the true picture is. I don't have a reference frame. But perhaps, because of all the AQR and because of all the effort that the RBI has put in, the level of NPAs may not be far different from what we now know.
Sure.
It's quite possible that there are some unknown unknowns which are by definition unknowable. But I think we now have a fairly reasonable estimate of what the level of NPAs is.
Fair enough, sir.
To that extent, where we don't know the truth is about whether we have a game plan to address this. And as Dr. Ahluwalia said, we're able to recognize that there is need for steep haircuts from the banking system, and whether they take it now or whether they take it later, we got to address that head on in order to solve this problem. By kicking this down the road, we're only making it worse.
Right. Dr. Subbarao, staying with you on institutions, FRBM will clearly need to be changed now. And it's, in a way, it's surprising it's not being changed as yet and addressed as yet. Are there some fundamental changes required to FRBM? Are the targets of 40% central debt, 20% of GDP state debt, do those need to be revised as well? Is there a need for a fiscal council? What would you suggest are the changes required around the FRBM and the overall fiscal picture? Well,
the FRBM has evolved over several years, right? And right. Amendments to the FRBM. Okay. So as far as some targets are concerned, like 20%, 40% for debt GDP ratio, or fiscal deficit of 3% for central government or 2% for state governments. These are not numbers pulled out of thin air. These are numbers that have been estimated, taking into account our growth, our tax policy, our efficiency, etc. So to say that we will not put any numbers, that we will just say that the government must behave responsibly and just give a mandate, I don't think is correct. In every democracy, especially in a vigorous democracy like ours, it is very, very important to put some hard number limits. So you can change 20%, 40%, 60% now, you can change up to 65% debt to GDP ratio if you believe that growth in the medium term is going to be lower. But doing away with limits, I'm not agreeable with.
Sure.
Similarly for the fiscal deficit as well, because fiscal deficit is a flow number, debt to GDP is a stock number, one translates to other, we must have something.
Right.
The second amendment, the FRBM or whatever fiscal responsibility, I would say is this, about, when we were drafting the FRBM, there was a lot of hope pinned on how the FRBM will extract responsibility from the government.
That's right.
Okay. But in the event, it's been a huge disappointment. Why? Because, under the FRBM, the government is expected to submit some documents to the parliament about a medium-term fiscal strategy, a medium-term expenditure framework, a medium-term revenue framework, etc. The government has been dutifully doing it. Nobody notices it. So it's a great disappointment that we have institutions, we have systems of checks and balances, but the people who should be demanding accountability, that is the parliament, is actually not interested enough to do that. So I think that's the problem we need to fix. You can do any number of amendments to the FRBM, but if ultimately the institution that is expected to enforce accountability from the government is not doing that adequately, you need to address the problem there rather than in amending the FRBM.
That's right. That's very well put, Dr. Subbarao. Thank you so much. Dr. Ahluwalia, in case you want to add something to that, and I have a couple of questions for you to add to that. One is, you're an advisor to the Punjab government as things stand today. Center-state relations, particularly for some states, seem really frayed around the economic and financial question. So your thoughts on what's happening to that institution of center-state relationships? And in a way connected to that, the finance minister also announced a lot of agricultural reforms. Do you welcome that? They sound like a good idea. Do you think they're good, welcome steps? And why have they taken so long to come about, to be honest?
Well, on the issue of agricultural reforms, we're looking at that in the context of this expert group. I totally agree that they're extremely important. I'm not sure, for example, how much of those are in the hands of the central government as opposed to the state government. But
That's
you know,
right.
some things clearly are. And one of them is the Essential Commodities Act. That's a central act. I don't know exactly what change is proposed to be made, but I do agree that I don't think it's a very productive act. It is not an act which will encourage any investor to get into the business of agricultural marketing. My personal view is it should be repealed. But you know, I don't know what reform means, so we need clarity. But
Right.
for example, if the government of India is intending to repeal the Essential Commodities Act, I would applaud that immensely. But we need to know what they have in mind. Agricultural reforms, particularly allowing leasing of agricultural land, in my view, is extremely important. Again, reforming the agricultural produce marketing committees, that's extremely important, but it's in the hands of state governments. I mean, the central government can give a model law, but the control lies in the hands of state governments. You know, on the center-state relationships, I mean, it's whenever you're hit badly, I mean, particularly on the revenue side, I mean, both the center and the states are hit badly. And it's a natural instinct of the states to say that, look, they don't have any more revenue capacity. All the revenue capacity rests with the central government. The state government, I mean, with the GST in particular, they cannot actually raise indirect taxes on consumption in the state government. So their view has been that, look, compared to what we were expecting to get by way of revenue from the center, we're going to get much less. You don't seriously expect us to cut our expenditure. I mean, for the simple reason that states' expenditure is exactly in the areas of health and education and so forth.
Right.
So we need some special grant, a COVID grant or something like that. And the center should take the burden of that on its own budget. Now, I don't think there's been a response. The Punjab Chief Minister made such a suggestion in a letter that he sent to the Prime Minister. I have no idea whether they have got a response. But states do expect something. Now, what they have got, and I think this should be mentioned, I think they've got a generous increase in the borrowing limit.
That's right.
But you know, most of these states are debt stressed. So in effect, the issue really is, would it have been better for the center to take on the borrowing responsibility and then pass on the money to the states as a special grant? Or is it better to let the states borrow? Obviously, if the states borrow, then the states end up having to repay, and different states will be able to borrow at different rates. You can make a case either way. But I think we need a clearer understanding of many things. Take a very simple issue. At the moment, we want to restore normalcy. The key to restoring normalcy is logistic movement.
Right.
I hear lots of stories that, you know, although the central government has clearly said there should be no restriction on movement of either essential or non-essential commodities across states, the fact is that lots of restrictions have got imposed. So somewhere or the other, like I would say that if the center really wants to do something to make the country a national market, interstate logistics movement should be very strictly enforced that you can't interrupt. But on the other hand, you've got problems where the Chief Minister of UP is reported to have said that if you want labor from UP, you have to get the UP government's permission. I don't know whether that's true, but clearly there's a lot of lack of clarity, and we need clarity of this.
Sure. Thank you very much, Dr. Ahluwalia. I'm going to toss over now to Dr. Subbarao. First of all, apologies. We've already passed 12 noon India time, so apologies for that. I'll try and wrap it up fast. One is, of course, Dr. Subbarao, you've been both state cadre as well as central cadre, so I would love to hear your views on the center-state relationship. Thereafter, I'm going to ask both of you to give your closing comments. I realize that questions have been highly biased by what I have in my head, so it's quite possible there are stuff with you that you have not been able to articulate. But I would love to hear your closing comments on where we are, short-term steps, medium-term steps, and institutions, or anything else that you would want to add. But to you, Dr. Subbarao, first the center state, and thereafter your closing comments, please.
Yeah, center state, I want to make one comment, which is that the central government must recognize and acknowledge that the economic center of gravity has shifted from the center to the states.
Right.
In a number of ways. First, look at economic reforms, structural reforms that we talked about. all the reforms that Dr. Ahluwalia and Dr. Manmohan Singh did in 1991 could be carried out of Ministry of Finance and not block. Look at external sector, exchange rate, financial sector, industrial delicensing, whatever was done in 1991 could be done by the central government. Today we're talking about second generation reforms in land, labor, investment, taxation, power sector, etc. You cannot do this without the active cooperation, indeed the consent of state governments.
Right.
The second thing is, even as you talk about improving the ease of doing business, as I said earlier, it is the states that are at the front line. So you can do excellent, you can have excellent policies in Delhi, excellent policies in state capitals, but it is the states that have to get things done, improve the experience for investors at the front end, which means the governance reforms also states are important. The third thing, if you just look at the fiscal dynamics,
right.
Historically, of the combined revenue of the center and states, the central government collects about 60%, state governments collect about 40%.
Right.
On the expenditure side, the central government gets to spend 40%, the states get to spend 60%. So it gets a mirror image of that. Amazing. If anything, that ratio is shifting increasingly towards states. So the prosperity of our country, our economic prospects, our prospects as a nation are dependent much more on how the states perform than indeed how the center performs. And the central government needs to recognize this and work much more closely with the states on resolving national issues.
Excellent. Thank you very much, sir.
On the summing up, would Dr. Ahluwalia go first?
Why don't you go first, sir? That's fine, since we've been speaking.
Okay, we've discussed a variety of topics, and thank you so much for conducting it so well, Ananth. And I want to acknowledge Dr. Ahluwalia's great contribution, intellectual contribution to this. But what I want to say is that even in spite of this grim scenario that we're going through currently, I believe the medium-term India growth story is quite intact.
Right.
And we have a growth driver that most other countries do not have, which is 1.3 billion people, half of them low income, per capita income of just about $2,000. As Nobel laureate Abhijit Banerjee said, you put money in the hands of those people are going to spend. That's going to lead to production, that's going to lead to investment, that's going to lead to jobs, and that's going to lead to growth.
Right.
So we can get onto a virtuous cycle much more easily than most other countries, including, in fact, China. Right. And we need the right policies. We need to accelerate our growth rate. We need to make sure that the benefits of growth go to low-income households. And I believe that the secret to India's, or not the key to India's success in the medium term will depend on exploiting that growth driver. Our medium-term growth story is strong. It's possible, probable, but not inevitable.
That's a beautiful way of saying it, sir. Possible, probable, but not inevitable. So we can't take it for granted, I guess. So a lot of work to be done. Lots of fantastic ideas you've provided as well. And I do hope the powers that be are listening to this and in other forum as well. Dr. Ahluwalia, I'm going to give you the last word as far as summing up is concerned. I'm going to say the pleasantries after that, but the content will be left to you for summing up, sir. Thank you very much, and all yours.
Well, thanks very much. First of all, Ananth, thank you for an excellent moderation. You managed to bring out a lot more from, I think, both of us, Subba will agree. And I must thank you for organizing this session. You know, for summing up, just one or two interesting points. First, we're only 2.5 months into the lockdown, into this handling of the COVID crisis. So in a way, a lot of flexibility exists in what we do for the year as a whole.
Right.
So I would just hope that whatever emerges are the key issues of uncertainty get quickly resolved. And also that there's more consultation between the center and the states so that people get a sense of what is the nature of the national effort in handling the current situation. The focus on the current situation inevitably will be how we handle the health side, right, and to what extent do we get the economy back again. I mean, as Subba said, we are not in a position where we can impose lockdowns which lead to a collapse of livelihood. That'll lead to a lot of loss of lives. And I think some of those options are still open. But whichever way you look at it, this is going to be a bad year. So really all our energies should be spent in making sure that from next year onwards, we have a set of good results. Now, my guess is that next year, a quick recovery, another 5% or so, will happen unless we muck up the rest of this year.
Right.
We should take no comfort from that, because that is just bringing us back to what 2019-20 was. The name of the game is, are we going to do enough in the course of the next year to get the economy back on a healthy track? I think 8% is simply no longer feasible. You know, as Subba said, 7% is possible. I'm not sure how probable, but let's say anything that's possible is probable to a certain degree, but without doubt will require massive effort. I think we need to be clear, what are the 4 or 5 big things that are needed in which we are clear about what we're going to do.
Right.
And I think we need to go beyond slogans to specifics and recognize that in the specifics, there are differences of view. Now, I mean, clearly you've got to fix the banks.
Right.
There is no chance of India getting to 7% growth by 22, 23, if the banks aren't fixed. So we've got a whole year to fix those banks and take care of the problem. You know, there's endless differences of opinion on what to do. So let's have a discussion on what we're going to do and let's elicit comments. There are many different views there.
Right.
It's not just the banks, it's also the NBFCs. So it's not very clear exactly what we're going to do in addition to the banks to fix the NBFCs. That's something.
Right.
I personally feel that this big issue of becoming a part of the global supply chain, I happen to have the view that although next year globalization will be different from what it has been, it's not going to be a wholesale retreat from it. And countries that succeed are the ones that will utilize the opportunities best. I think for that, we need to be more rather than less open. We are still amongst the most unopen, although we are much more open than we were before. And I noticed that from some of your comments that have been flickering on the screen, there are people who feel that, say, the RCEP was not fair to India. And we have to ask ourselves that if there is a regional agreement that 15 countries think is fair to them, I mean, are we absolutely clear that it's not fair to us? Every agreement has some difficult ends and some gains. So I think that's kind of issue that we need to fix on. And the point that Subba made on institutions and ease of doing business, I mean, frankly, I don't put much store by these international ratings because they're based on a checklist type of approach. Many business people tell me that even with the best will in the world, when the government says something, that's not how it works in practice. Let me just close with one example. People constantly complain that tax authorities are too aggressive in sort of assessing large tax liabilities. I was told a few weeks ago that the Central Board of Direct Taxes has told all the tax officers that there is no change in your tax collection target. Now, if the GDP is going to decline by 5% and the tax collection target was based on a 6-7% real growth, and you tell the tax collector that, look, your target is the same, you're virtually asking for impossibly high tax revenue targets being set. And that will almost certainly lead to harassment, and you can't blame the tax officials. This is an example where I think a clear statement that, look, we know revenues are going to be lower, therefore targets are lower. This should be done.
Fantastic. I couldn't have asked for a better summing up. Thank you very much, Dr. Ahluwalia. Dr. Subbarao, anything else you would like to add, having listened to Dr. Ahluwalia? So great. Thank you both very much. I have to confess, there were lots of good questions which came up in the chat. I was studiously ignoring them because I was trying to get all the answers to the questions in my head. So apologies to all those lovely participants who put up all those questions. I will try and pick the brains of both these gentlemen separately. There were lots of other questions I wanted to ask, to be honest, around geopolitics, around monetary policy framework, and so on and so forth. But that can wait another day. Thank you both very, very much. I think what's been personally enlightening for me, lots of ideas on all these issues, where we stand, what are the short-term steps, great discussion around the fiscal space that we have. We saw different perspectives coming out. Great overview of the monetary steps being taken, Dr. Subbarao. Thank you very much for that. Lots of great ideas, Dr. Ahluwalia, on the reforms that need to be pursued. I love the ideas around the tax reforms, around subsidies, around globalization, etc. I think they make a lot of sense. Thoughts around cleaning up the financial sector, Dr. Subbarao, I think they're absolutely fantastic. I'm speaking off memory. I'm going to go through this transcript again and try and prepare a summary of all the lovely suggestions you guys have put forward. I think they're extremely enriching. Deeply grateful. I'm going to put in a small plug for SPJIMR and CFS. We would love to do more of these sessions. We will try and get in more. I doubt if we can match the eminence of this particular panel, but we will try and get more speakers to debate this and more issues. Thank you again very, very much, Dr. Ahluwalia and Dr. Subbarao, for supporting us and for offering your views very candidly, very openly, and very, very constructively. Truly appreciate, indebted to you. Thanks very much. And look forward to more sessions. And we're going to close the chat out here unless Dr. Subbarao or Dr. Ahluwalia any other comments. We're going to close the chat here. I promise you the edited piece of this particular webinar. I'll send across to you as soon as it's ready, as soon as the SPJIMR team is ready. And I'll also try and give you transcripts of the main points that we discussed. Thank you very much. Good day to everybody. Greetings, everybody, and lovely having the session together. Thank you.
Thank you very much.
Thank you. Thank you, sirs. Really appreciate. I think it was fantastic. I'll send you the summary of.
Bye.
Yeah. Thank you. Bye-bye.